Welcome to vTalkInsight, Allocator's Lens Daily for February 11th, 2026. Equities sit close to record highs, led by artificial intelligence-driven technology. Bonds are rallying despite persistent inflation and policy risks, and credit markets are absorbing large issuance at tight spreads. For multi-asset portfolios, the tension between concentrated growth in a few themes and a broadening global recovery is front and center today. In equities, the core story is that global indices are pressing new highs, but the leadership mix is shifting and increasingly fragile. United States technology names tied to artificial intelligence remain the main engine, with strong earnings and capital spending plans driving the benchmarks. Yet Europe has quietly joined the party, with European indices also at record levels and luxury stocks leading gains on positive surprises. A key pillar of this strength is the semiconductor complex linked to AI infrastructure. TSMC has reported January sales up 37% year-on-year and is ready to deploy as much as $56 billion of capital expenditure, underscoring confidence in sustained AI demand. At the same time, acute memory chip shortages are pushing DRAM prices dramatically higher and are expected to persist for years, boosting producers like SK Hynix and Samsung, while putting margin pressure on downstream users in electronics and autos. Beneath the headline indices, regional and sector rotation is still very much alive. European luxury and consumer names are seeing renewed interest, with companies such as Kering, Gucci, and Hermes easing concerns about Chinese demand and demonstrating that ultra-luxury spending remains resilient, while Zara is targeting consumers trading down from luxury into higher quality, mid-market fashion. European banks are another focal point. Barclays and UniCredit both plan very large capital returns over the coming years, reflecting strong profitability, although performance dispersion across the sector is high and valuations are becoming more demanding. Despite the upbeat tone, several fault lines run through the equity complex. Market participants highlight that some momentum trades, including parts of technology, precious metals, and digital assets, may still need to correct further before conditions stabilize, and that the recent rotation from United States megacap tech into value and international equities could already be stretched. There is also concern that United States growth is increasingly concentrated, with AI-related capital expenditure and high-end consumption accounting for the bulk of expansion, raising questions about sustainability if a string of weak hiring and spending data were to emerge and derail the current tilt towards cyclicals and value. On top of that, rapid AI-driven disruption is injecting volatility into areas such as insurance, legal services, and travel platforms, where business models and margins are being reassessed. Upcoming United States retail sales, jobs, and inflation releases, arriving in a tight window, are therefore critical catalysts for whether this AI-led but fragile equity rally can broaden further or needs to consolidate. Turning to rates, government bond markets are sending a more cautious signal than equities. Despite negative headlines for long-dated bonds, including political uncertainty, ambitious growth forecasts, and concerns over fiscal paths, global bonds are rallying and yields remain contained, with recent volatility episodes leaving surprisingly little net movement so far this year. In the United Kingdom, gilt yields spiked around political headlines and then retraced as key cabinet members offered public support, underlining how sensitive long-duration assets are to domestic politics as well as to inflation data. Policy expectations sit at the heart of this rates puzzle. The Bank of England now projects inflation returning to its 2% target in the second half of the year, paving the way for rate cuts and reinforcing the broader global narrative of gradual easing that is already supporting credit growth and a more synchronized recovery. Against that, the United States faces a cluster of important data releases on retail sales, employment, and consumer prices, with risk skewed towards stronger jobs and stickier inflation. That could keep a more orthodox Federal Reserve Board-leaning data dependent and potentially hawkish, even as investors continue to add duration. Japan offers a different kind of reassurance, where high headline debt is offset by substantial public assets and low servicing costs, giving investors some comfort that fiscal pressures are manageable for now. Credit markets are expressing one of the clearest risk-on signals in the current environment. Global bond issuance is running hot, and the standout story is Alphabet's record $20 billion deal, which drew around $100 billion of demand and priced at yields less than 1% over comparable United States Treasuries. The company is also tapping sterling and Swiss franc markets, including plans for ultra-long 100-year notes aimed at insurers and pension funds, highlighting intense appetite for high-quality, long-duration corporate risk, even with geopolitical uncertainty elevated. This demand is intertwined with the AI investment cycle. Alphabet is using its funding capacity to support very large data center and AI infrastructure programs, while TSMC's ramp-up in capital expenditure reinforces how much of the global credit machine is now financing a small group of technology champions. Spreads remain tight for these issuers, suggesting that investors are comfortable with long-term cash flow visibility, but also concentrates exposure in a handful of names whose earnings must keep pace with their capex to justify current pricing. More broadly, as global growth broadens and central banks edge toward rate cuts, credit activity is picking up and spreads are tightening across high-grade markets, even as private credit and more marginal borrowers face tougher scrutiny. Financials and emerging market infrastructure add further layers to the credit story. European banks, such as Barclays and UniCredit, are signaling confidence through ambitious capital return plans running into tens of billions of pounds and euros, backed by strong earnings, although sector-wide upside may be tempered by rich valuations and rising dispersion between winners and laggards. At the same time, African infrastructure and mining projects are drawing more attention. Historically, they have delivered annual returns in the high single to low double digits with very low default rates, and new first loss guarantees and currency hedging tools from multilateral agencies are making this segment more accessible. The United States government's $12 billion critical mineral stockpile and new financing vehicles underline how strategic supply chain objectives and credit markets are becoming increasingly intertwined. Foreign exchange is comparatively subdued, but it still carries important information for allocators. The dollar has been trading in a relatively tight range as markets wait for the upcoming United States retail sales, employment, and inflation data, with expectations now set low enough that a positive surprise, especially on jobs, could give the currency and global risk assets another near-term lift. At the same time, a longer-term narrative of gradual dollar weakness persists as capital slowly diversifies away from the United States toward regions where valuations look more compelling. Europe sits at the center of this rebalancing debate. Concerns about euro strength are present, but company-level analysis suggests that even a move in euro-dollar toward 1.3 would have only a modest impact on aggregate European earnings, while a structurally softer dollar would tend to support European equities and bonds by drawing in global flows. Sterling, by contrast, remains weighed down by the prospect of Bank of England rate cuts and by domestic political uncertainty, both of which have already shown up in gilt volatility. Against this backdrop, currency markets are expressing policy divergence and political risk more than simple growth differentials, and how they respond to the next data wave will be an important cross-check on the moves seen in equities and bonds. Commodities are increasingly driven by strategic policy choices rather than just the traditional business cycle. Nowhere is this clearer than in critical minerals, where global demand is outpacing supply because exploration and project investment have lagged. There is a sizable gap between the financial capital currently committed and what would be needed to support a full-blown commodity and energy transition boom, prompting governments to step in with new funding models. The United States has created a $12 billion critical mineral stockpile and is ramping up engagement in Africa, where infrastructure and mining investments have historically delivered 8 to 13% annual returns with very low default rates, now supported by first loss guarantees and currency hedging to draw in more private capital. Energy and technology-related commodities add further complexity. BP's suspension of its share buyback program, alongside a renewed focus on divestments and cost-cutting, highlights how traditional energy majors are balancing shareholder return expectations with balance sheet repair and the funding needs of the energy transition. In parallel, acute shortages in memory chips have driven DRAM prices sharply higher and are expected to persist well into the second half of the decade, effectively turning certain semiconductor segments into scarce, quasi-commodity inputs that support producer profits but raise costs for a wide range of manufacturers. Combined with ongoing geopolitical tensions and higher defense spending plans in Europe, these dynamics reinforce commodities' role as both an inflation transmission channel and a strategic hedge within diversified portfolios. Stepping back across assets, the picture is one of resilient risk appetite but rising concentration and policy tension. Equities are being pulled higher by AI-heavy technology and a recovering Europe, even as dispersion widens and the rally looks sensitive to any disappointment in growth data or earnings. Bonds are rallying in the face of mixed inflation signals and political noise. Credit is embracing long-duration technology and bank issuance at tight spreads. Currencies are quietly discounting policy divergence, and commodities are shaped by structural underinvestment and strategic stockpiling in critical minerals. For allocators, the key watch points now are the clustered United States macro releases, the evolution of European politics and defense spending, how AI disruption plays out across non-tech sectors, and whether capital continues to flow into long-dated corporate credit and critical resource projects at the current pace. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.